Hello everyone, my name is Craig Adler. I'm a retired certified financial planner. I'm also sometimes known as the Angry Financial Planner. Today we are going to be taking a look at and discussing 4 very popular and common investment strategies. The goal is to help you understand the differences and be able to make informed decisions on how you might want to structure your own investment portfolio. This video is for educational purposes only, and remember, before you implement any strategy, please seek the guidance of your own financial professionals. The 4 portfolios that we're going to be looking at today are FIRE, which stands for Financial Independence Retire Early, Buffett, Ramsey, and the Boglehead 3 Investment Portfolio. Let's go ahead and look at the structural differences to start. The FIRE investment is the most simple of the portfolios to implement. It has 100% of its money in a total stock market index fund. The Buffett portfolio is similar, but at the same time, slightly different. It has 90% of its money in a stock investment, 10% in high quality, short-term fixed income or treasury investments. That 90% stock exposure, based on Buffett's recommendation, comes from the S&P 500 index fund. I am frequently asked, well, what's the difference between a total stock market index fund and the S&P 500 index fund? Here is the primary difference. The S&P 500 index fund has a large cap focus. The total stock market index fund also has a large cap focus, but it does include exposure to mid cap and small cap investments. It is more broad based and highly diversified, and that is why that investment is my general preference for getting US equity exposure. But let me say this, the risk reward characteristics of the 2 portfolios are almost identical. Over the past 10 years, the S&P 500 has outperformed the total stock market index fund by about 0.5% on an annualized basis. And that is because large cap has outperformed mid cap and small cap. Otherwise, they are almost identical investments, and I wouldn't get too caught up on that difference in terms of structuring your own portfolio, even though I do suggest total stock market index funds for US equity exposure. The 3rd portfolio we're going to look at is Ramsey. Ramsey's approach is quite a bit different. It is the first of the portfolios that includes international exposure at 25%. The final 75% has a growth focus. It is 25% growth, 25% growth in income, and 25% aggressive growth. So in some ways, it looks a little bit like the FIRE model in terms of it's 100% stock. It does take a very different approach, though, in that it is 25% international, and it has a pure growth focus on the US equity side, ignoring value investments. The 4th and final model is the Boglehead 3-fund portfolio. There are many different ways this portfolio can be structured. I set it up this way, which is 75% stocks, 50% US total stock market index fund, 25% total international, and 25% total bond market index fund. So those are the 4 portfolios, and here are some high-level conclusions that I would make. The first conclusion is this. For a younger investor, early in the accumulation phase, I believe that all 4 of these portfolios can and should allow you to reach your long-term investment goals if you have the discipline to hold the positions and continue to contribute and save money at an adequate rate. They all have high equity exposure. Therefore, they all should allow you to reach your investment goals if you make the underlying assumption that equities, and specifically US equities, are going to reward us for long-term holding periods going forward. And that really would be the only reason you'd want to own these investments anyway. So I do believe that is a fair assumption to make. So once again, all these portfolios are probably appropriate for younger investors early in the accumulation phase. For older investors like myself, or for someone that has already reached their financial goals, I personally would not be comfortable with any of these portfolios. In my opinion, they just have too much stock exposure at this point in time. I have another video out there where I forecast equity and bond returns. That might help you understand why I've reached that conclusion. But for someone close to reaching their financial goals, these portfolios are just a little bit too aggressive for my taste. In terms of which of these portfolios would I suggest if I had to pick one, I believe in international exposure and I believe in broad-based, highly diversified portfolios. I really only get that from the Boglehead model, so that is the portfolio that I would suggest. But remember, before you implement any strategy, please seek the guidance of your own financial professionals. Here are the returns of these investments. I didn't want you to see those too early because I would be concerned that you would only focus on historic performance. That is not the way we want to evaluate portfolios. With that being said, notice that the worst performing was the Boglehead model, but remember, it also was the most conservative. It had the highest degree of fixed income exposure. Over this past decade, U.S. equities have outperformed fixed income or bond portfolios by almost 11% on an annualized basis. I just don't see that happening in the decade going forward. In the comment section, let me know which of these portfolios would you select and why. I have created this channel to help improve everyone's financial literacy, but I need your help as well. Please support the channel by subscribing. And remember, when it comes to our money, it is always better to be educated than angry.